Have you ever wondered if in this tough market you can purchase your first home or upgrade to a bigger one? What will be the consequences? So today we're gonna talk to a mortgage broker. Hopefully he gives you clarity, more details, and confidence to make the right move. Hi, I'm Milena. I'm a local real estate agent in Burlington, Ontario. And today I will introduce you to a mortgage broker who will answer a couple of questions regarding rates, what's going on in the market, and first-time home buyers. I have a couple of scenarios for him, so let's get this started and see if we can help you purchase your first home. Make sure to subscribe to our channel because our team drops content every single week about things that are happening in our area, so we keep you up to date. If you need any help finding the right place in our area, make sure to send me an email, give me a call, shoot me a text, or we can do a Zoom call. Whatever works for you, we're here for you. Despite the fact that we were expecting very good fall market, that didn't happen. So I am going to ask Copeland what is he thinking about it and why maybe the market will get better or not in the spring.
Yeah, so I think I generally try to shy away from making a prediction in terms of what's going to happen in the future. I have my opinions, but I've seen it happen where my opinions were wrong. And I've seen it where all the experts who make opinions on the market with all their research and all their data can also be wrong, right? So you were mentioning about CREA, so the Real Estate Association. I think they were predicting something like 3 to 5% housing price growth in this year. We've literally seen the opposite, if not more than a decline of 5%. During COVID, when COVID started, CMHC came out with this announcement in March of 2020. Real estate in Canada was going to go down by 15%. And during the course of 2020, we saw the exact opposite, where prices probably increased 15% or more. So anyways, I just think it's one of those things, it's hard to make a prediction. What I'm seeing now is that this is not my expert advice as a person in the industry. This is me as a homeowner living in a city in Welland. I see the homes on my street selling at prices lower than they have probably in the last 5 years, right? So what will help buyers to make the decision right now in this kind of economy? Because something else that we're reading on the news, and there is another thing that it's actually in reality. Yeah, so I think one would be to speak to a realtor like yourself to get boots on the ground information of like what is actually happening in the market, what prices are, like you can see the prices homes are listed at, but like what do they actually sell for? And within the area and the type of home that they're trying to buy, get a better understanding of like what is that actual price. I think the other that is something that I think always stays relevant is look at your personal situation, your personal budget, like how much are you paying in rent right now maybe, what can you afford to pay in a monthly cost, and within that amount, are there homes available in your area? In the long term, does it really matter if prices go down next year? But if you're buying a home and you're going to live in it for the next 5 to 10 years, you're going to raise a family there, you're going to live your life, I would recommend people not to make their decisions so much on the market. I personally believe it's better to make your decision 80% based on your situation, your finances, what you need, you and your family need. And then 20% is now a good time or is now a bad time. I think you can definitely, you include that into the equation, but I think it's silly to make that 80% of the equation and then 20% what you actually need in terms of the home that you want to live, right? The rates recently dropped and we are expecting more traffic in the spring. At least that's what CREA said as well. What do you think about that? Will they drop more? I know you don't like prediction, but something to help buyers in general. Yeah, so historically, banks tend to be more competitive on interest rates during the spring market. So that is when more transactions happen and more lenders compete, meaning they bring their rates lower to get more business during that time. So that has always been the case. I think right now already we've seen a few lenders become very competitive, bringing interest rates for some of the fixed rates and the variable rate at around 4% or even below 4%. So that was something that even myself, I was looking forward to when rates were above 6%. I thought when rates go below 4%, that would be a big shift in terms of sentiment, because it's something people can make their plan on longer term. 6% interest rates were, I think, very hard to bite the bullet to purchase a home. Like there's like most of your payment is going to interest, right? It was a hard place to be. But I'm not yet seeing, at least within my business, I'm not yet seeing this huge influx of demand based on rates reaching 4%. And it's been, it's gone a little bit higher, a little bit lower, but probably for the last 6 months, we've had rates in and around, say 4.25 and down to like 3.89, like within that range. So I feel like maybe if interest rates go lower, it could help the market, but I think that it's becoming less of a conversation and more of it is becoming like your job security. How do you feel? Like, are you positive on the outlook over the next few years? I think that's becoming a bigger part of the equation than interest rates.
Right, with all the layoffs that are happening lately.
Yeah.
Whenever people are choosing interest rates, they always ask how the mortgage will be affected if they go with variable or set. So what would you recommend?
So I think it goes back to, it's a personal decision for people. I don't believe there is one right or wrong answer. I've seen studies that have looked back on the last 30 to 50 years of interest rates and making that decision. And the rule of thumb generally, it's not always correct, but generally is if you choose the lowest rate at any given time over the life of your mortgage, so 25 to 30 years, you will generally pay less interest. So what that means is if the variable rate is cheaper, you go with variable. If the fixed rate is cheaper, you go with fixed. And over a long period of time, that tends to work. Now, in the last few years, it would not have worked because you would have taken a variable rate at 1.5%. It would have gone up to 6%, where the fixed was at 2%, and you would have stayed at 2%, right? But over time, over 25 to 30 years, that generally tends to be right. I think from a personal perspective, when I'm working with clients, if they're really stretching themselves to their limit to purchase a home, like they're really using all their qualifying ability, there's no room for error, I would generally go with a fixed rate so that they know what their interest rate is over the next 5 years. They're going to pay down the mortgage and they only have sort of interest rate risk at the end of the 5 years. Mm-hmm. If someone has a lot more flexibility, so say they're buying at half of their maximum purchasing power, and this is more when people are moving up from their starter home to their next home. I'm seeing more clients where they're pre-approved for say $1 million, 1.2, but they're buying at 700,000 or 800,000, right? So they have the ability to afford much more. In those cases, it's more their choice, because even if rates go up, they have the room in their income to pay those higher rates if needed. So they can also take the risk to start with a lower variable rate if that's the direction they want to go.
So let's say from fixed rate of 2%, you go to a fixed rate of 4%. How do you navigate that?
So what we're seeing is that even though the interest rate doubles, the payment generally goes up around 33%. So the payment doesn't double. The portion of the payment that goes to interest definitely doubles, but usually it's about a 33% increase. So if the client can afford it, then many times we just increase the payment. If they're getting stretched and they want to look at other options, many times if they've been paying down this mortgage for 5 years, an option is to consider extending the amortization of the mortgage. So say you started at a 25-year with a low down payment, you're now down to 20. In some cases, we can actually stretch it out to 30 years. And this way it brings down the payment maybe to make it more manageable. Long term, you pay more interest with a 30-year mortgage. But if someone's in a tight spot right now, it can be a tool to just keep them in their home and keep the payments more affordable.
Okay, so there's a way to go about that. Okay, great. Another question is how brokers do get paid, because people are wondering, why would you push one lender over another? What's your choice here?
Yeah, so we get paid from the lenders. Like the way I explain it usually is that a bank or a lender has a choice of opening up a branch, hiring employees to sit in it, doing advertising to get people to that branch to lend mortgages, or they can pay brokers to send them clients and send them mortgages. So that's sort of why they pay us. So as a consumer, you don't really pay something extra out of pocket. You just get the mortgage at that interest rate, and we get compensated by the lender. That compensation can definitely change. So for example, we tend to get paid the most on a variable rate mortgage or a 5-year fixed mortgage, so the 5-year term. When it comes to shorter term mortgages, like a 3-year or a 2-year mortgage, we definitely get paid less. That's just the structure of how the compensation works. And time to time, some lenders will offer a promotion of like, for within this 3-month period, 2-month period, we'll pay sort of a bonus on top of our regular commission. And that's their way of incentivizing to get more business their way. So it is part of the nature of how this business runs. The way that I've run my business, at least this is what I hope I do, is that I will simply look at what is the best option for the client. What we get paid is sort of the secondary aspect of it. And I feel if I do a good job with enough clients, long term, it will work out. So I don't need to make the most out of every single file I work with. And there are cases that, like many times especially when people call me about a renewal, many times I'm just telling them, go back to your bank, ask them what the interest rate is. And like 80% of the time, they will offer you a rate that I cannot compete with. And then it just makes sense to go back to them. Now, I don't get paid anything to say that, but it's in the best interest of the client. And
that's very interesting. Yes, because I know the banks work for themselves, and the mortgage brokers are something else. You pull different lenders and you check options. Okay, that's interesting that you can refer the clients back to the banks.
Yeah, I mean, we don't get paid anything for that, but I think it makes a lot of sense if it's in the best interest of the client. Right now, if they're looking to take money out of the mortgage, if they're looking to extend the amortization, if they're looking to make a change, at that point, it makes sense to go through the requalifying process and we can look at what options best fit them. But if they're saying, I'm happy with this mortgage amount, I'm happy with the amortization, I don't want to make any changes, I just want to know what's my best option. Many times I will tell them, okay, ask them for what their best option is. I'll tell you what my best option is. And if their option is better, just sign the paper and accept it. And many times it helps when you go to the existing lender to say, I'm talking to a mortgage broker, I'm ready to move my mortgage away unless I get a good offer. And then many times that makes the existing lender give them a good offer.
Oh, yeah, that's a very good tip. Very good tip. Do you always wonder if there are hidden costs in your mortgage? Because I always do. So now my question to you is, how do you break down the mortgage to the clients?
Yeah, in terms of breaking it down, so in our pre-approval process, we break down sort of what's the monthly cost, what's their closing costs, and like what is their cost of ownership. So that's more like a budgeting scenario. In terms of hidden costs, the biggest hidden cost when it comes to mortgages, like the interest rate is pretty straightforward, right? Like there are some differences based on how they calculate it, whether they compound it monthly versus annually, but those tend to be small differences. The biggest cost that I've seen and I've experienced is when it comes to the penalty to break the mortgage. So especially when you're going with a fixed rate mortgage, you either pay a 3-month interest penalty to break it, or you have a interest rate differential penalty. And interest rate differentials are calculated based on the interest rate that you got the mortgage at and the difference from that to the new interest rates. So especially like right now when interest rates are going down, that penalty actually goes up. And the way they calculate it is not always straightforward. So it is actually like one of the secrets, but it's not really a secret, that many of the big banks charge extra on how they calculate that differential penalty. And they actually give a lower interest rate to start. So they will give you a low rate to start. If you stay till the end, you will benefit from the low interest rate. But they know on average, some percentage of clients refinance within 2, 3, 4 years. And they will make an extra profit on that differential penalties to offset the fact that they gave the lower interest rate to get the business in the first place. So it's something to consider. That's where it's really important to know what is your plan with this home. Are you even thinking about upgrading? Are you thinking about moving, right? And that plays a part in choosing which lender to go with. And sometimes it may make sense to either go with a variable rate or go with a lender that may charge a slightly higher interest rate, but at least the way they calculate the penalty is not going to be as painful as potentially a lender that charges a huge penalty. And the final point is there are some lenders that do not let you break the mortgage. Now, they will offer a very much lower interest rate to get business, but they will tell you, like, we will not allow you to refinance this home. You cannot pay us anything to get out of this. And one of my contacts who was a law clerk. So she worked at a law office. So you would think someone in that position, they can get the lawyer to write up a letter, send it to the lender. She tried everything she could. She couldn't get out of it. She had to wait the 5 years. So, yeah.
I didn't know about that. I know about the penalties, but I didn't know that you can get out of it.
Yeah. Now, we generally stay away from those type of mortgages. I know like some clients, they're so focused on the interest rate and they're like, how can I get the rate to be lower than XYZ? And sometimes those are the only mortgages that offer that much lower rate. But I've not done one of those mortgages so far. I just stay away from it.
If you need any help finding the right place in our area, feel free to reach out. My information is in the description box below. You can reach me via email, phone call, Zoom, whatever works for you. I'm there for you. So I'm gonna show a real case scenario here. Let's say I'm purchasing a home for $600,000 and I'm putting only 5% down.
Yeah.
What I'm facing in terms of insurance and what are my options? Let's say I put 20% down. Let's do both.
Okay.
So first the 5% down.
Yeah, so when you buy a home with 5% down, you pay, so you can't actually put 5% on a 600,000 purchase. It's only for the first 500,000. And then you have to put 10% down on the next amount. So essentially 25,000 of the 500,000 and then 10,000 of that remaining 100,000. But yeah, essentially when you put a low down payment, there's something called mortgage insurance. And essentially what ends up happening is of your 5% down payment, something like 4% gets given to one of the mortgage insurance companies. But instead of you having to pay that out of pocket, they add it to your mortgage. So instead of starting at 95%, it's close to 99%. And that's kind of the price you pay to be able to put a low down payment. If you have 20% down, you don't need to worry about that. You just get a regular mortgage.
But what will be the mortgage difference in both cases? So let's say I put 5% on 600,000 and then I put 20% of 600,000. What will be the mortgage difference into both?
Yeah, so that's a hard question to answer. I always use calculators when I'm running these numbers. The only difference is the payment will be lower with the 20% down based on how much smaller the mortgage is. So if you start at a 600,000 purchase, your mortgage may be, $595, versus if you put 20% down, your mortgage may be $480. So the difference in payment is going to be roughly 20%, which is the difference in the mortgage amounts of the different scenarios.
The next question is for people who are moving from abroad to Canada. Let's say if they move to United States and they want to bring their saved money here and buy a home, what they need to do? Do they have to bring the money in advance or they can use US bank?
Yeah, so generally, whenever you're buying a house, the process is a lot easier once the funds are already in Canada. So generally, in terms of how most of the lenders look at it, once the funds are in the country for 3 months, they don't really ask for a history beyond 3 months. So that's the general rule of thumb. If it's less than 3 months, but it's coming from a country that, essentially, when it comes to anti-money laundering, right, each of the countries abroad are given different sort of risk categories. So depending on where the money is coming from, and depending on the financial institution it's in currently, where it's coming from, the lender may be okay with a couple of months history from that institution, or they may say, no, we're not going to touch it until the funds are here and a certain period of time passes before we're able to purchase a home. So the rule of thumb is if you're moving to Canada and you want to buy a home, it's generally best to have the funds in Canada, let it sit for 3 months. That way, at that point, the money's here and you're able to purchase a home.
Okay, so basically, if you're planning to move, get with an mortgage broker, and this way you know how to navigate your mortgage if you're financing the home.
Yeah, and specifically for people moving to Canada, if you have income from a foreign source, especially if it's a multinational company in a foreign country, we actually have mortgage programs as well where you can use that income, the foreign income, to help qualify for a mortgage here in Canada.
Actually, that was my next question. Let's say, because I have a friend, they already own a home, but their business is in Brazil.
Okay.
So how they got qualified, I never really asked them because their income comes from there. It doesn't come from Canada. So let's say I have 300,000 to put down and my extra money, my business is in Bulgaria. So what do I do?
Yeah. So again, this is based on the country and the type of income. I think Using self-employed income from a foreign country becomes much harder. But if it is a salaried income from a company that is multinational, that makes it a lot easier, because then the lender sees the T4 slip, or not the T4, but like the payroll slip, and they know that the company is legitimate. It's not just in that country, but it's in multiple countries, especially if it's in Canada as well. That gives a lot more credibility to that employment. Yeah, so with using foreign income, generally speaking, a larger down payment helps, right? If you can put a 35% down payment, that is usually the tipping point where it opens up to many more countries. US based income, there are a few lenders that are okay with a 20% down payment, and they'll look at income from the US. But self-employed foreign income is probably the hardest. I just did a file for self-employed foreign income from the States, and that one we were able to make it work. But if you're in any other country than the US, at least with A lenders, it becomes much tougher. B lenders, we have some that are a little bit more flexible, but you end up paying lender fees and you end up paying a high interest rate.
Right. I have a case that I wanted to discuss with him, that a family that was first-time home buyer found a house, beautiful, that you can live on the top floor, and it had a basement apartment that needed renovation. So they needed that income in order to qualify for the mortgage. How you would go about that?
Yeah, so one of the programs that I like quite a lot is what's called the Purchase Plus Improvements program. So this program allows you to roll the cost of a renovation into your mortgage. So if there's already an apartment there that needs work, or sometimes maybe there's no apartment there and you want to add the apartment, you need to get some quotes. You need to do this before you close on the property. So when you're putting the offer, ideally get a quote. We're able to take that quote, give it to the lender, get an approval for the mortgage to purchase the home, and an approval for the amount of the renovation you're trying to do. And generally, as long as you're improving the home, you're adding some value through renovating it, we're typically able to get anywhere from as low as $5,000 up to $100,000 in terms of funds to do a renovation like that.
And that's gonna be cumulative payment, right? It's not gonna be one payment for a mortgage and one for the renovation.
That's right. So it's all just one mortgage at the end of the day. So the important thing to keep in mind is that you do need to qualify for both the mortgage to purchase and that amount you're doing for renovation. So for example, if your pre-approval is up to $600,000, you need to buy less than $600,000 if you are going to add a renovation amount. So the total of the renovation and the purchase cannot be more than your maximum pre-approval.
Okay, that's good to know. So let's say they want to use that potential income towards the mortgage. Will that count into the approval process?
Yeah, so that's the nice thing. If you have a home with a self-contained basement unit or a self-contained separate unit, we're able to use that income to help you purchase at a higher price. So for example, if you have a home with a basement that can rent for $1,500, we often see that increases the pre-approval amount by close to $100,000.
Okay.
Now, if there is the potential to put a basement apartment, say there's a finished basement, has a bathroom, but doesn't have a kitchen, it's not separate yet. Say you get a quote for 20, 25 grand to put a kitchen, to separate it. We can roll that 25,000 into a Purchase Plus Improvements. And if we do that through the Purchase Plus Improvements, we can also get an appraisal for the rent to use towards purchasing at a higher price. So even though the apartment doesn't exist yet, as long as you're planning on doing it, you're applying for a Purchase Plus Improvements, we can get you that benefit of using that future rental income.
Another case, let's say you're a business owner and you have really good amount of money coming your way, the cash flow is good and the bank can see that, but for some reason they don't want to approve you for that mortgage, for the
Purchase Plus Improvement.
Purchase Plus Improvement. Why?
Yeah, so it's hard to know the specific reason they may decline someone. Like what I can think of is this: if
this is a self-employed.
Yeah, with self-employed, it's not just enough that someone makes a good revenue. The bank is going to look at what is your profit. Right. So, and especially if you're incorporated, they're going to look at what is your profit in the company and what do you actually pay yourself personally. So my guess is that if that self-employed client had to go to a B lender, because B lenders will look at what is the revenue and what is the income in your company. So I have some B lenders that will just look at your top line revenue. They will look at your industry and they will say if the industry has roughly a 50% profit margin, they will just take your revenue and say 50% of that is your profit and your actual profit may be 10 or 20%, but they will say this industry generally has 50%, we will use 50%. So you can use that as your income to qualify. So it really helps to qualify as a business owner. But most of the B lenders don't have a purchase plus improvements program. I know of one B lender that has it, and they're one of the more stricter B lenders, versus there's many other B lenders that are more flexible. On the A lending side, it shouldn't make, I've done a purchase plus improvements for a self-employed client, but he had enough income personally from his company to qualify for that A lending mortgage. And at that point, we were able to get him the purchase plus improvements.
My last question is for first-time home buyers. Let's say you have $3,000 rent every month and you're tired of it and you want to have something on your own. What would you recommend for this first-time home buyers to help them out, step on their feet and get their venture with their own housing?
Yeah, so one of the unique programs that I recently discovered, it's been around for a little while, but I only found out about it in the last year. We have a lender here in Niagara who will also lend up to Hamilton. Hamilton's kind of their furthest they'll go. They won't really go to Burlington or Brantford, but Hamilton, Niagara area. They have what they call a cashback mortgage program. And this is for someone who can qualify income-wise, but they don't quite have a down payment to purchase a home. They will give up to 5% of the mortgage amount as a cashback that you can use as your down payment. So if you only have the closing costs saved up and you haven't yet saved up the full down payment and you can afford that monthly cost, that's an option to consider. And I would recommend people not to stretch themselves by going into a program like that, but rather if they're already on track to purchase a home in a year or 2 years, it may just speed up the process. And like you said, if they're already paying $3,000 in rent, if they can do something like this where the mortgage payment is $3,000, or even if the mortgage payment is higher, say it's $4,000, but they're buying a home with a basement apartment and the income from that basement can help to offset the cost, that's where I feel this is a program that can really speed up people getting into the market.
Yeah, that's what we talk about, right? Any other incentive besides that?
Yeah, so I mean, I think that's one of the unique ones.
I think very helpful. 5%. Yeah. I'll take it.
Yeah, absolutely. Other than that, I think generally speaking, I like to recommend people to buy homes with basement apartments in general. Like if you're open to living with a tenant, especially when you're a first-time buyer, most of the first-time buyers I work with are purchasing at the maximum of what they can afford. If you talk to financial planners, they always say, don't spend more than 33% of your income on a home. That's just not realistic. Almost every first-time home buyer I'm talking to is pretty much going to the max, because that's barely getting them the home that they want, and it's not even the perfect home.
That's right.
So
yes.
I think realistically, if you're going to do that anyways, okay, now let's look at how can the property pay for itself. So it doesn't always have to be a basement unit. Like even if it's like, say you have extra rooms that you rent on Airbnb, or you do something so that the property can help offset some of the costs. It doesn't have to be forever. So like the home that I live in, we have a little basement apartment. We rented it for 2 years, I believe. And then at the end of it, my wife and I decided, you know what, I think we don't need the income anymore. And we just opened the wall between our main floor and the basement. And now we have a basement to use for ourselves. We have a kitchen that we don't use in the basement, but it's additional space for us. But in the first couple of years, it helped, right? We kept our costs lower. And I would recommend if you're a first-time buyer, just be open to that possibility. If it can make a difference to get you in the market or keep your costs within what you can afford.
That's right. We need to navigate through the prices, and that's a very good example. Well, I hope that really helped you. If you need any mortgage advice, you can find his information below. I will post it, and this video will go also on his YouTube channel. Thank you so much for staying with us, and I'll see you on the next one. If you have any comments or questions, make sure to put them in a box below. And if you want to reach out, my information is also in the description box below, and you can reach me via email, phone call, Zoom, text, whatever works for you. I'm there for you. Same for Cocoon. I'll give you his information so he can help you with your mortgage. And thank you for staying with us throughout the video. I'm Milena. I'm your real estate agent here in the West GTA area. You have a great day, and I will see you on the next one.